Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 11th of February 2020. And yesterday we produced our video entitled Euro Falls Again as Dollar, Equities and Gold and Silver Rise. And on Sunday we produced our 2020 gold price forecast. Links to both have been placed in the description box below. Now later today we shall be publishing our silver forecast for 2020, but this will appear within the Inner Sanctum and will be released generally next week. It's likely this will appear quite late this evening, probably between 9 and 10 o'clock GMT. Now today we're going to briefly talk about a subject we are frequently emailed about. How come, when equity markets generally fall every 10 years, this has not come about this time? And is the extension of a couple years beyond the 10 just a short-term one, with us on the brink of such a decline? In other words, why hasn't the stock markets of the world, and in particular the American markets, collapsed already? Now this in truth is a difficult question to answer, or at least answer sufficiently, as there are so many factors which can cause equities to fall, and to even attempt to suggest that one has the absolute knowledge of what is going to happen would be both arrogant and misleading. What we can say in general, though, and this is now borne out by some quite famous investors, hedge fund owners, economists, and investment experts, that we are in a slightly, not totally, but a slightly different position today than we have been in previous decades. Now, arguments of this, it'll be different this time, have often been made, only to be proven wrong. And we have no doubt that at some stage the equity markets will fall. But let us say why they can actually survive and prosper much longer than many people think. You see, apart from the 2008 economic crash until now, interest rates have never been so low for so long. And the concept of negative rates was previously unheard of. Now, in addition, the consistent printing of money and initially loading it offshore and then ensuring it is invested in certain asset classes, but not all, has prevented inflation, let alone hyperinflation, from occurring domestically. There is no doubt that what we in monetary circles call loose money is often seen as attractive by equity markets, certainly while it fails to cause inflation. And to be frank, they benefit from the additional funds thrown their way. There is, however, for those in the know, a more pernicious undercurrent that also assists markets to perform well. And that to some degree, this is the remuneration many of those involved in it receive when such markets improve and continually reach all-time highs. Now, contrarians will also make money when markets decline, but in the main, they make the most money as an average group when markets improve. Now, very few, if any, individual traders have sufficient power or leverage to move markets, though perhaps a Buffett is about as close as one can get as far as an individual is concerned, or some of the major fund groups as far as organizations are concerned. But as a group, in other words, the industry as a whole, working towards a common goal, that is, higher equity markets, it then becomes almost an unstoppable train. To a large extent, hedge funds have also had quite a considerable impact. And we've seen today an article in Bloomberg showing the magnitude of what some of these fund heads can earn. Those running the funds can earn monies that are both mind-blowing and make President Trump look like a pauper. Now, before we read this article, we must say up front that we're not suggesting for one moment that these people get together and make a deal in a back room, or that individual hedge funds can have a major impact on the market as a whole. But if the whole industry benefits when prices rise, it's hardly surprising that many in that industry ignores the clear warning signs and sometimes even deliberately interprets negative news as positive news. Now, generally we're all taught in investments that it is a zero-sum game. One has to lose for another to gain. And that generally is true. But you can still lose and gain in continually rising markets, because those who sell may very well buy back again and then sell again at another profit later on. But there is no doubt in our view that those involved in investments during continually rising markets undoubtedly benefit just as much individually, and sometimes even more, than the clients they represent. So when we are quick to say, well, a market crash is just around the corner, it's also worth remembering that normal rules do not apply. And it is, certainly in this US election year, in the investment community's best interests, the central bank's best interests, the Republican Party's best interests, and Donald Trump's best interests to ensure that the equity bubble remains inflated and perhaps even pumped up a little more. So we are most certainly not writing the Dow, S&P, or Nasdaq off quite yet, and we suggest nor should you. So let's take a look at the article, and once finished, if you haven't already done so, please subscribe to this channel and press the bell sign. And also, utilizing any of the links that we've included below that you may deem appropriate. So let's get over to this article. Bloomberg article dated February 11th, 2020, 12:41 p.m. GMT. Headline: 5 hedge fund heads made more than $1 billion each last year. $12 billion. It's more than JP Morgan Chase & Co. paid all 56,000 of its investment bank employees, and almost twice as much as gamblers lost in Las Vegas last year. It's also what 15 hedge fund managers collectively earned in 2019. 5 of them, Chris Hohn, Jim Simons, Ken Griffin, Steve Cohen, and Chase Coleman, reaped more than $1 billion each, according to estimates by the Bloomberg Billionaires Index. The rewards for the men, and they're all men, are notable, especially given only a third of the 15 managers on the list beat the S&P 500 index's 29% gain last year. It also comes as the hedge fund industry has been grappling with closures and mediocre returns. It then explains the $1 billion club. The 5 highest paid hedge fund managers all made more than $1 billion in 2019. So Chris Hohn, 1.845 billion. Jim Simons, 1.7. Ken Griffin, 1.5. Steve Cohen, 1.260. And Chase Coleman, 1.105. Hedge fund advocates say they're supposed to profit regardless of whether the market goes up or down, and performance shouldn't only be compared with equity indexes. Still, many were boosted by soaring stocks as central banks, including the Federal Reserve, kept monetary policy loose. Many of the firms made money betting on the same stocks, typically tech names. More than half of those on Bloomberg's list counted Alibaba Group Holdings Limited and Facebook Inc. among their top 10 contributors to equity returns, according to an analysis of regulatory filings. Quote, "If that's where the opportunity is, it's where it is," unquote, said Darren Wolf, head of alternative investment strategies for the Americas at Aberdeen Asset Management, which invests in hedge funds on behalf of its clients. Quote, But it creates challenges for us, unquote, he said, because Aberdeen's clients already invested in indexes heavily weighted with tech stocks. Most of the managers on this year's list charge fees of at least 20% on gains, even as the industry is slashing fees, amid pressure from investors disappointed with years of lackluster performance. Representatives for the firms on the list declined to comment. Marcus Frampton, Chief Investment Officer for Alaska Permanent Fund Corp, said his firm, which oversees $68 billion, is, quote, happy to pay 20% in fees, unquote, as long as a manager consistently produces benchmark-beating returns, quote, that represents skill, not market exposure, unquote. Hone 53 topped the rankings after his TCI fund management gained 41%. The London-based activist was lifted by concentrated bets on stocks, including Alphabet Inc., Microsoft Corp., and Canadian rail companies. Griffin 51 made $1.5 billion through his multi-strategy funds. That doesn't even take into account his market-making operations, Citadel Securities, which generates billions more in revenue. Simons, 81, features prominently on the list even though he retired from Renaissance Technologies a decade ago. His ownership stake in the firm, which now manages $75 billion, plus his investment in the secretive Medallion Fund, almost guarantees that he'll continue to be among the highest paid managers for years to come. Bridgewater Associates founder Ray Dalio collected $480 million, down from $1.3 billion in 2018, after his flagship fund, Pure Alpha 2, lost money for the first time in 2 decades. Dalio's all-weather strategy fared better, gaining almost 17% last year, while he continues to have a sizable ownership interest in the $160 billion Connecticut-based firm. We will be talking about Dalio in future videos, so do listen out. Some very interesting facts about that gentleman. The list excludes those who no longer manage external capital, such as Michael Platt and Stanley Druckenmiller, but it is notable for featuring so many Tiger Management alumni. Tiger Clubs, the next generation. Meet Chase Coleman's protégés. These are the so-called Tiger Clubs who worked for legendary investor Julian Robertson, and Tiger Grand Clubs. Lone Pine Stephen Mandel and Tiger's Global Coleman each gained more than 30% in their main funds. Andreas Halvorsen of Viking Global returned 18%. His former chief investment officer, Dan Sundheim, returned 22% at his relatively new firm, D1 Capital Partners. Quote, they all had good years because they tend to be net long, unquote, Alaska's Frampton said of the Tiger complex. And that net long is the very point that we have been making today. End of article. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.